this is Rochelle Agatha, and this is the Chapter 1 lecture for Accounting 101. You have many tools to use for this book. In my accounting lab, there are several things, and this is the lecture as if you were taking the class in class. So there are learning objectives within the book for this chapter. So really the first thing about Chapter 1 is to be able to do basic accounting, the basic accounting equation, and preparing the basic accounting statements, the income statement, the balance sheet, and the owner's equity statement. And there are other lectures on my website that go over basic accounting statements, etc. And feel free to watch anything that you want on my website. It's definitely more information to help you out. Okay, so accounting is the language of business. That's what it is. When I teach accounting, I like to tell people it's like learning Spanish or French. It is math, but it's really a language, and it provides information to many different people and stakeholders, as you can see. The accounting process analyzes, you're looking at what happened, you record, you put it in some kind of system, you classify, you group similar things, you summarize, which totals, and then you report. And then there's interpreting and communicating. So accounting is not just a bean counter thing, and if you're a really good accountant, a really good financial analyst, you'll see in the long run it is not just putting numbers in math equations. Accounting information is provided for many people, individuals, businesses, large corporations, governmental agencies, nonprofits, for-profits, etc. We deal in this class a lot with the sole proprietorship, which is one owner. There's a partnership, which is at least two owners, and then there's a corporation, which is owned by stockholders, and that corporation may be public or private. Here's a slide. Feel free to print it out. Kind of goes over the different types of ownership, which is also covered in many other classes like business, intro to business. There are different kinds of business classifications. So within those types of companies, there are business classifications. There are service companies, merchandising companies, and manufacturing. And really, in this really entry-level accounting, we're working a lot with service providers, like consulting firms, law firms, accounting firms, cleaning firms, anything like that. And here's another slide you can go over and check it out. Generally accepted accounting principles and international financial reporting standards guide what we do as accountants. So you will hear reference to these a lot, and it is what keeps accountants honest. It's what keeps corporations honest. There's a difference between bookkeeping and accounting. There are a lot of people in the world that are bookkeepers. It is recording basically based on cash. Accounting prepares financial statements and involves a lot of complexity. So there is definitely a difference between a bookkeeper, who's very clerical, and an accountant who's trained to report information in accordance with GAAP and IFRS. A business is a separate business entity. That's why there is an accounting equation. And you may know people who have their own business and they don't keep things separate from themselves. But when you are an accountant and you do accounting for a business, that business is considered separate. It's a separate entity. So here is the key, one of the first key things you need to learn. Assets equal liabilities plus owner's equity. That is the accounting equation. It always must balance. Assets are properties or value owned by a business. Things you might have heard of: cash, land, supplies, equipment, etc. Equities are rights of the financial claim to the assets. So where there's no debt to anybody, assets will equal equities. Liabilities are obligations. So you might go to the bank and borrow money to buy the equipment to start your business. That becomes a liability. Liabilities have creditors. Creditors are the people that you owe for that liability. Once again, liabilities are total claims against the assets. So when you have liabilities, assets will equal liabilities plus owner's equity. So think of it like this. You own your stuff, and you either own it outright, so you are a full equity owner, or you have people you owe money to. That's where the liability people come in, the creditors. Capital is the owner's investment in a company. So when you watch some of those lectures on my website, you'll see reference to equity, to capital. Depending on when I taped it and for what class, just keep in mind that when you're a little tiny sole proprietor, it's owner's equity. When you're a corporation and or a partnership and there's people involved, other people, there's capital. And it all is capital. Objective 2, recording transactions. This is really important. You're going to do a lot of this in my accounting lab. If you invest $6,000 to start your business and you put $200 of office equipment, you're going to get $6,000 of cash, $200 of office equipment, and on the other side of the coin, you get equity of $6,200. If you started your business today and ended it tomorrow, you would still have the $6,000 cash, the $200 equity, or $200 equipment, and then the rest would be yours equity. Then you say on August 29th, the law practice buys more equipment for $500 cash. Notice this transaction happens on the same side of the accounting equation. This kind of stumps newbies in accounting. You add your $6,000 minus your $5 is $5,500. But you got office equipment for $500, so now you have $700. Nothing happened over here because it all is over here. It didn't affect your capital. Cash went away, equipment came in, you still have $6,200. On August 30th, you bought additional office equipment for $300, but this time you bought it on debt. You went to Staples and you opened an account, let's say. Now you have $300 of office equipment and you have this $300 you owe somebody at the end of 30 days or when it's due. Notice your equity stayed the same, but now you have debt, so your assets equals your liabilities plus your owner's equity or your capital. An account payable is a promise to pay. The balance sheet shows the history of the company. It is the report that reports financial position as of a particular date. It presents ending balances in assets, liabilities, and owner's equity. Assets always appear on the left side. Liabilities and equity appear on the right side in the basic balance sheet. So as a newbie accountant, this is the way your balance sheet looks. It's very simple. Over here are your assets with your total. Over here are your liabilities and your owner's equity with a total. The totals always match. So when you prepare balance sheets, you have to your assets have to equal your owner's equity plus your liability. If you're off, you've made a mistake somewhere. This is your test right here. These two must match each other. Preparing the balance sheet. You're going to put the heading on, the company name, the name of the statement, the date for which the statement is prepared. And you're going to use dollar signs at the columns at the top and the columns on the bottom. Let me see. Whoops. Learning objective 3 is you're going to look at revenues and expenses. Revenue is the amount you earn from your services or selling your goods. It increases owner's equity, and you record it when it's earned. Assets increase if cash if the client pays right away, accounts receivable if the client promises to pay. So revenue, you're going to get it when you earn it, whether you get cash or not. And that is the difference between accrual accounting and cash accounting. Expenses are incurred. You record expenses when incurred. They decrease owner's equity. You once again record them when incurred, and whether you pay it in cash or you charge it. So that is once again accrual accounting, not cash accounting. These are the differences between bookkeepers and accounting. Revenue minus expense equals net income or net loss. If your revenues are bigger than your expenses, you have net income, and it increases equity. If your expenses are greater than revenue, it's net loss, and it decreases your equity. Cash or other assets removed from the business to pay personal expenses are called withdrawals. So you can own your business, and you can be a sole proprietor. You can't just take money out of the business and not do anything with it. That is called a withdrawal. That decreases your owner's equity, and of course it'll decrease the cash or the asset that you took it out of. It is not an expense. It's not an operational part of doing business. It is a withdrawal. So here's your owner's equity. You have beginning capital plus any additional investments plus revenue minus expense minus withdrawals is your ending capital. So let's do a little transaction. This is the same one we did earlier. Now you're going to provide legal services for cash. So you got cash and then you had revenue because you're a law firm. So notice your equity's going up. Now you're going to provide legal services on account, meaning the people didn't pay you. So you're going to set up an account receivable and you still record the revenue whether the cash is not there or not. And this is where a lot of small businesses get in trouble because they don't hire an accountant and they think cash drives everything. It's not the cash that drove this transaction. It's the performance of the service. Now you receive $900 as partial payment for the previous services. That is not revenue. That is cash and a reduction of AR because they paid off their account receivable. And now you paid salaries to your employees. So your cash went down and you have an expense. Notice the plus right here. Keep in mind, expenses are a decrease to equity. So the one thing this book doesn't cover, which I really like to cover, is the normal balance of an account, which I have a whole lecture on my website. Assets are positive. They are debit accounts. They have a normal balance of a debit. Liabilities are negative. They have a normal balance of a credit. And owner's equity has a normal balance of a credit. That's how this thing stays in balance. Your debits equal your credits. Within the owner's equity, you have your credit of revenue. Don't let the plus sign mess you up. You're on the right side of the equals, so you're on the credit side of the account. So you have revenue is a plus, capital is an additional investment is a plus, a withdrawal takes away, and an expense takes away. So just keep that in mind and come back to this lecture if you need to, because we're going to cover it a lot. It is really important, and watch those other lectures on my website. Now you're going to pay rent expense for $400. And now you're going to incur advertising expense of $200 to be paid next month. So here you have your accounts payable and your expense because you bought it on account. So there's no cash involved. On September 1, you withdrew $100 for personal use. So here's your withdrawal. You have a $100 withdrawal. You're increasing your withdrawal account, but you're decreasing your equity because a withdrawal decreases equity, and cash came out of the business. All along, this line is staying in balance, which is really, really important. Here's the whole thing. This is the worksheet, and I encourage you to print this out. I think this example is actually in your book, and really make sure you understand all these transactions. And learning objective 4 is preparing the actual statements. So remember, we talked about the balance sheet. The income statement shows the business results, revenues, expenses, and net income, and it covers a period of time. It is not as of a period of time. So it's a month, a quarter, or a year. Preparing statements are done at the end of a period, and you put your company name, the name of the statement, and the period of time. So this is what an income statement looks like. Notice it says for the month ended, or the year ended, or the quarter ended. It has the name of the company. It has revenue less expenses equals net income. You put your dollar sign at the top of each column and at the bottom with a double underscore. If you're going to be an accounting major or a business major, you need to get used to this kind of formality. Owner's equity statement is owner's equity is increased by the investment, increased by net income, decreased by withdrawal, decreased by net loss, which we kind of covered a minute ago. Here's your owner's equity statement. You start with your beginning capital plus net income or minus net loss, less withdrawal is your increase or decrease in capital, and there's your ending owner's equity. That goes on the balance sheet. And then here is for the month ended, and it shows you a picture here, but for a month ended is the statement of equity. And come on down. And there's that balance sheet we saw earlier. Notice that the Mia Wong capital is the ending amount that was on the owner's equity statement. Here's all the different pieces that you can trace back and go back to all those transactions and see where they came from. What goes on each statement? This is a cool slide. Might make a flashcard. I really like flashcards. I think flashcards are great. Listen to the lectures and make flashcards. And then the main elements of the income statement, I think you guys can read these slides. Once again, I just want to make sure that you know that there's other lectures on my website, and feel free to listen to anything and send me an email if you have any questions. Thank you.